Hi everyone. Today let us understand few basic concepts of accountancy. So let's see the first one, that is business. So what do you mean by business? Business is buying and selling of goods and services with an aim of earning profit. So when a person is into buying and selling of goods or services and he has an aim of earning profit, which means he is not doing out of charity or voluntary purpose. He is doing for making money out of it, wherein his aim is to earn profit. It will be termed as business. Second, accountancy. Accountancy is nothing but it is recording of all the business transactions. So all the day-to-day transactions, purchases, sales, day-to-day expenses, all these transactions which takes place into the business. And when you record these transactions in your books of accounts in a systematic way, it is called as accountancy. Goods. Goods are commodities that are meant for sale. So when a person sells a commodity with an intention of selling and not for self-consumption, it is termed as goods. Capital. Capital is any amount that is invested into the business by the businessmen is called as capital. Drawings. Drawings is completely opposite of capital, which means any personal withdrawings which are done by the businessmen are called as drawings. So capital is nothing but the amount that is invested into the business, and drawings is nothing but personal withdrawals that are made by the businessman for his personal use and not business use. Then it will be termed as drawings. Liabilities. Liabilities are the debts or obligations of any person. Okay, so when a person is obliged, responsible to pay, to return the money, okay, so any borrowings that he has and which he is supposed to return to someone, it is called as a liability. Assets. Assets are simply properties or rights of any person. Assets, for example, furniture, plant and machinery are called as assets. They can further be classified into fixed assets or current assets. So fixed asset, as I said, plant and machinery, furniture will be termed as fixed assets, whereas current assets are cash in bank, bills receivable, debtors, they will be termed as current assets. Moving further, debtors. Debtors are the persons who have to repay the debt. Now, to understand this in detail, let us see this example. We have Mr. A and Mr. B. Mr. A decides to sell goods of rupees 5,000 to Mr. B. Mr. A is selling goods of rupees 5,000. Mr. B is agreeing to buy at the same amount, but he says that I will be paying this 5,000 on a future date. So, in such a situation, Mr. A, who is giving the credit, the benefit of paying money in future, is called as a creditor. So one who gives the credit facility to pay the amount in future is called as a creditor. Whereas Mr. B, who is agreeing to pay the amount in future, is called as a debtor. So he is the one who is liable to pay the money on a future date. So that's it for today. Thank you, everyone. I hope everybody understood these 10 terminologies. Thank you.